The world has long believed that the dollar became dominant simply because it was the most trusted currency, backed by the most powerful economy. But what if that wasn't the whole story? What if the dollar's rise had less to do with trust and more to do with control? And what if the moment that transformed the dollar into a tool of global influence was not a gradual evolution, but a specific turning point that still shapes every nation's economic decisions today? Before we unravel the moment the dollar shifted from facilitating trade to enforcing global decisions, we need to step back to the early 20th century, a time when no one imagined that a single nation's currency could hold such overwhelming power. Back then, trade was messy, fragmented, and determined by local agreements. Gold flowed across borders, empires set their own rules. But beneath all of this was a slow-building pressure that would eventually push the world toward a currency revolution. The United States didn't begin the century as an empire of finance. Its real advantage was timing. As Europe burned into world wars, the U.S. industrial machine grew uninterrupted. Factories expanded, gold reserves swelled, and the country became the world's primary supplier of materials. Other nations still clung to their own systems, hoping to return to pre-war stability, unaware that the old financial world was already collapsing. It was in 1944, at a quiet mountain resort in New Hampshire, that the story changed forever. Delegates from 44 nations gathered for what would become the Bretton Woods Conference, believing they were constructing a system of stability. What they built instead was the foundation for a financial hierarchy with the dollar at its peak. The U.S., holding nearly 3/4 of the world's gold, positioned its currency as the anchor. Every other major currency was tied to the dollar, and the dollar alone was tied to gold. On paper, this was meant to be a stabilizing mechanism. But beneath the idealistic language, something more strategic was unfolding. By making the world dependent on dollars, the United States effectively made global trade dependent on American policy. Every central bank needed dollars in their reserves. Every trade agreement relied on dollar liquidity. And every nation that wanted access to global markets suddenly had to participate in a system whose rules were created by one government. At first, it worked smoothly. The world was rebuilding, and the dollar provided consistency. American factories produced the goods that reconstruction demanded, and the U.S. government printed dollars to finance global recovery. But the comfort of the system disguised its fragility. The more dollars the U.S. printed, the more pressure grew on its gold reserves. The promise of convertibility, dollars exchangeable for gold at a fixed price, became harder and harder to maintain. Nations began doubting whether the U.S. had enough gold to redeem all outstanding dollars. France, under President Charles de Gaulle, openly challenged the system, sending battleships across the Atlantic loaded with dollars to exchange for physical gold. Other countries watched closely, wondering if the dollar standard was built on confidence or illusion. The world sensed something was about to break, but no one could predict how dramatic the break would be. In a televised address, President Richard Nixon announced that the United States would temporarily suspend the dollar's convertibility into gold. In reality, the convertibility would never return. Overnight, the world's financial anchor was severed. The dollar was no longer backed by gold but by the global need to use it. And this marked the turning point. The dollar was no longer just a medium of trade. It had become a lever of influence. Without gold, the dollar might have collapsed unless the U.S. could create a new mechanism to ensure worldwide demand. The answer emerged in the 1970s when the U.S. negotiated historic agreements with Saudi Arabia and OPEC. Oil, the lifeblood of modern economies, would be priced exclusively in dollars. Every country on earth needed oil. Therefore, every country on earth needed dollars. The petrodollar system was born, and with it, a new era of monetary power. This new system created a feedback loop. Countries needed dollars to buy oil. The U.S. could run large deficits without the same consequences other nations faced because the world required American currency to function. What began as convenience had transformed into dependence, and dependence gave way to control. The dollar was no longer a passive tool of exchange. It was the architecture of global power. This growing influence became visible in the 1980s and 1990s, as the U.S. shaped global financial institutions and leveraged the dollar's role in international banking. Nations that opposed American policies often found their access to the global financial system restricted. Sanctions became a powerful weapon not through military force but through currency exclusion. The dollar had become an instrument not just of commerce but of compliance. But this concentration of power came at a cost. As the U.S. economy shifted toward financialization, the dollar became increasingly detached from domestic production. Industries moved offshore, capital markets expanded, and the dollar became a speculative asset traded at volumes far beyond actual global trade needs. This created volatility, especially in emerging economies tied to dollar-denominated debt. Countries like Mexico, Thailand, and Argentina experienced devastating crises when U.S. monetary policy shifted abruptly. Nations borrowed in dollars because global institutions encouraged it. When the U.S. raised interest rates, those nations faced higher repayment costs. Their currencies collapsed, their economies contracted. The dollar was not just the global currency, it was the global choke point. By the early 2000s, the consequences of this system grew even more pronounced, especially during the 2008 financial crisis. When American financial institutions failed, the shockwaves rippled outward instantly. Countries that had no involvement in U.S. mortgages still faced economic collapse simply because the dollar-funded financial markets froze. Central banks around the world scrambled to secure swap lines with the Federal Reserve. Those that received support survived more easily. Those that didn't suffered severe downturns. This imbalance became a wake-up call for many nations. China accelerated efforts to internationalize the yuan. Russia began diversifying out of dollar reserves. Even allies questioned whether any single currency should hold so much power. Yet despite these efforts, the dollar remained dominant because no alternative matched its liquidity, its deep financial markets, or its entrenched role in trade. The breaking point arrived again not from war or recession, but from geopolitics. As sanctions against countries like Iran, Russia, and Venezuela intensified, a message echoed globally: the dollar is not neutral. Access to the system can be withdrawn. Payments can be blocked. Reserves can be frozen. In 2022 alone, more than $300 billion of Russian central bank assets were immobilized. For many governments, this crossed a psychological threshold. The financial weaponization of the dollar was no longer theory. It was undeniable reality. China and Russia expanded bilateral trade in their own currencies. Middle Eastern countries started exploring non-dollar pricing for energy. India and Brazil experimented with their own systems of settlement. Even Europe debated reducing dependence on U.S. financial rails. Yet none of these moves were complete solutions. Fragmenting the global monetary system introduces risk. But relying fully on the dollar carries a different kind of risk. Today, over 80% of global trade is invoiced in dollars, even though the U.S. accounts for less than 11% of global trade volume. More than 60% of global reserves are held in dollars, despite a slow decline from previous decades. But the most surprising figure is that only about 20% of U.S. dollars actually circulate inside the United States. The rest circulate globally, meaning more than half of America's currency directly supports foreign economies rather than its own. This imbalance mirrors earlier patterns in history where the dominant currency eventually faced strategic overreach. In the early 20th century, the British pound held a similar position until wartime spending and financial strain forced the UK to relinquish control. Reserve currencies rarely decline abruptly. They fade through slow erosion, triggered by geopolitical shifts, declining trust, or alternative systems reaching maturity. The story of the dollar today resembles a familiar arc. Nations are increasingly cautious about centralizing so much power. Digital currencies are emerging. Cross-border payment platforms are diversifying. What once looked like a permanent structure now appears more like a fragile equilibrium. The question is not whether the dollar will disappear at 1T but whether its role as an instrument of authority will continue unchallenged. Financial history shows that systems built on control eventually face resistance. And when resistance becomes widespread, systems evolve. The dollar's transformation into a tool of influence has brought stability to some regions, volatility to others, and strategic advantage to the United States. But every advantage has a cost, and every system has a breaking point. The next few decades may reveal whether the world chooses reform, replacement, or fragmentation. Today, nations are no longer asking whether they can live without the dollar. They are studying past crises, calculating vulnerabilities, and quietly building alternatives. But none of this guarantees a smooth transition. If the world shifts too abruptly, markets will destabilize. The next chapter is not predetermined, and that uncertainty defines the moment we live in. The irony of the dollar's journey is that a system built to promote stability now generates anxiety. A structure meant to encourage global cooperation now triggers geopolitical friction. And a currency once anchored to gold is now anchored to trust that nations cannot fully control. This is the mystery at the heart of the modern financial world. The dollar dominates not because countries want it, but because no one has yet built a dependable alternative. So the story leaves us with three critical takeaways. First, the dollar did not become powerful because of economic purity. It became powerful because of geopolitical strategy. Second, systems built on imbalance inevitably face correction, whether through reform or disruption. Third, the next global monetary shift will be shaped not by economics alone, but by politics, technology, and the collective desire for autonomy. The world now stands at a crossroads, aware that the current system is unsustainable yet uncertain about what comes next. Will the dollar evolve into a shared global currency, compete with multiple regional systems, or retain dominance through new forms of influence? If you want to explore more hidden economic turning points, untold monetary history, and global power structures that shape everyday life, make sure to subscribe, share this video, and join the discussion in the comments. Understanding the past is the only way to prepare for what comes next.